The average person loses over $1 million across their lifetime without ever making a single bad investment. No failed business, no stock market crash, no catastrophic decision. Just a quiet, invisible force working in the background every single day, draining wealth so gradually that most people never notice it until it is far too late. That force has a name, and almost nobody is talking about it. It is not debt. It is not overspending. It is not even poor financial planning, although all of those play a role. The silent wealth killer is inflation, not the headline number that appears on financial news, but the compounding, decades-long erosion of purchasing power that turns what feels like financial stability into something far more fragile than it appears. Most people understand inflation in the abstract. Prices go up. Things cost more. That much is familiar. But what behavioral economists and financial researchers have documented is that most people dramatically underestimate how inflation works across time. It does not feel dangerous because it moves slowly, and that slowness is exactly what makes it lethal. Consider this. $1 in 1990 had the purchasing power of roughly $3 today. That means someone who saved diligently throughout the 90s, kept their money safe in a low-interest account, and felt responsible about their finances was actually losing ground the entire time, not in their bank balance, but in what that balance could actually buy. Research from the Bureau of Labor Statistics tracking price indices over decades makes this pattern unmistakably clear. Inflation does not ask for permission. It does not announce itself. It simply takes. So why does nobody talk about it? Part of the answer lies in how human beings are wired to process financial information. A study from Princeton University examining financial decision-making found that people are far more sensitive to nominal losses, seeing a number go down, than to real losses in purchasing power. If a savings account shows the same balance it did 5 years ago, it feels stable. The fact that it now buys significantly less is an abstraction. And abstractions do not trigger the same alarm bells that a shrinking number does. This cognitive blind spot has a name in behavioral economics. It is called money illusion, and it is one of the most costly biases that ordinary savers carry without ever knowing it exists. The second dimension of the silent wealth killer is fees, not the dramatic, obvious fees. The small, compounding, nearly invisible ones, investment management fees, fund expense ratios, platform charges, advisory percentages. Each one individually looks inconsequential. A 1% annual fee sounds harmless, but research published by Vanguard and independently verified by multiple financial analysis firms shows that a 1% annual fee on a long-term investment portfolio can reduce the final value by 20 to 30% over a 30-year period. Not 1%, 20 to 30%. The fee does not just take money. It takes the compounding that money would have generated. It takes the compounding on that compounding. The damage multiplies silently across decades. Most people, when they sign up for a managed fund or a workplace pension scheme, do not read the fee structure carefully. Studies from the Financial Conduct Authority examining investor behavior found that the majority of retail investors cannot accurately state the fees they are paying on their investments. Many believe they are paying nothing at all. The money is simply gone before it ever appears, subtracted quietly before the balance is displayed. The third dimension is one that almost nobody frames as a wealth killer, but the data is unambiguous. It is time. Specifically, the time lost between earning money and deploying it productively. Every week a paycheck sits in a zero-interest checking account is a week of potential compounding that never happens. Every month a person delays starting an investment account because they feel they do not have enough to begin is a month of growth permanently lost. Research from the Employee Benefit Research Institute found that the single most predictive factor in retirement wealth was not income level, not investment sophistication, and not even savings rate. It was the age at which consistent investing began. Starting 5 years earlier, even with smaller amounts, consistently produced better outcomes than starting later with larger contributions. Time is the one resource that cannot be recovered, and for most people, it is being spent without awareness. The fourth dimension is the one most directly connected to everyday behavior. It is the slow creep of recurring costs, subscriptions, memberships, insurance policies that renew automatically. services that once seemed affordable and were never revisited. A study by Chase Bank analyzing consumer spending patterns found that the average household dramatically underestimates its monthly recurring expenses, sometimes by a factor of 2 or 3. These costs do not feel like wealth killers because no single charge is large enough to register as a threat. But in aggregate, across years and decades, they represent an enormous and invisible drain on capital that could have been compounding instead. There is a term used in financial planning circles: phantom spending. Money that leaves an account without a conscious decision attached to it. No one chose to spend it in the moment. It simply went. And because it went without a decision, there is no psychological record of it, no sense of having made a trade-off. The money disappears without resistance, and the wealth that it might have become disappears with it. What makes the silent wealth killer so dangerous is not any one of these dimensions in isolation. It is their combination. Inflation eroding purchasing power, while fees quietly reduce investment returns, while delayed action eliminates years of compounding, while phantom spending drains the capital that should have been invested in the first place. None of these processes announce themselves, none of them send a notification. They simply work consistently in the background every day for decades. The antidote is not complexity. Financial researchers and behavioral economists consistently find that simple, consistent, low-cost long-term investment strategies outperform sophisticated approaches for the vast majority of ordinary investors. The data from S&P's ESPIVA reports, which track the performance of actively managed funds against passive index benchmarks, show that over a 15-year period, more than 90% of active fund managers underperform a simple index fund. The elaborate solution costs more and delivers less. Simplicity, deployed consistently and early, is where the advantage lives. Understanding the silent wealth killer does not require a finance degree. It requires awareness. Awareness that inflation is always working, that fees always compound, that time is always moving, that small recurring costs always accumulate, and that the absence of a dramatic mistake does not mean wealth is being protected. It means the erosion is simply happening too slowly to feel. If this kind of financial clarity is rare in the conversations around most people, that is exactly why content like this matters. Sharing it costs nothing, but for the person who watches it and adjusts even one habit, starts investing earlier, audits their fees, cancels a forgotten subscription, takes inflation seriously for the first time, the financial difference over a lifetime could be measured in hundreds of thousands of dollars. A like or a subscription is what keeps this kind of education reaching the people who need it most. The average person loses over $1 million across their lifetime without ever making a single bad investment. Now the question is not whether the silent wealth killer is real. The question is whether anything will be done about it. It is never too late to start, but it is always more expensive to wait.